With tensions still running hot overseas and an increasing level of uncertainty for what will happen next, many investors are left wondering how best to proceed. This is especially true when it comes to certain stocks like Lockheed Martin, which is up in my portfolio to a 30% gain, Chevron, which I have up just over 70%, and South Jersey Industries, a stock I don't own, but it is up over 35% just in the last month, so we had to include it. And in this video, we'll be going through each of these to learn about some key stats, and we'll try and determine what you should do when considering buying more shares at these high prices. So that's what we have coming up first, and then later on in this video, I'll show you what's been going on in my neck of the woods, including how my portfolio performed this week, along with any dividend stocks I picked up along the way. Anyway, before we get rocking and rolling, if you guys are stoked to talk about some great dividend stocks today, then go ahead and give this video a big thumbs up. Also, leave me a comment below and let me know which dividend stock is currently the top performing stock in your portfolio. I would be very curious to hear which stocks have been winners for all of you out there. Anyway, thank you so much for doing that, and now, without further ado, let's get into it. All right, now as we mentioned just a moment ago, Lockheed Martin, which is the first stock we're going to be talking about today, has just skyrocketed in share price, guys. And in the last year, it is up about 31.4%. In the last 6 months, it is up a whopping near 26%. In the last 30 days, it is up close to 15%. And then just in the last 5 days, just this week, it is up nearly 10%. And I got to say, while it's cool to see this stock performing well, although the circumstances for it doing so aren't necessarily the best, it does make it more expensive to purchase, which is one of the downsides of having these stocks run up in share price so much like this one has here. And having said that, it does make the stock at less of a discount, which brings us to the next thing we're going to talk about, which is the valuation. And now looking at this page right here, we can see that Seeking Alpha gives Lockheed Martin an overall valuation grade of a C-, which is barely passing. Okay, Lockheed Martin is just barely skating by on its current valuation. But with that said, the PE ratio really is not too terrible. 16.71, which is below 20. And 20 is kind of the threshold that we use to determine stocks that could be a little bit discounted or ones that are maybe a little bit overvalued. 20 seems to be kind of the cutoff there. So anything below that, I think is worth taking a deeper look into. And this PE ratio also is about 6% lower than the sector median. And for those of you who don't know, Lockheed Martin is in the industrial sector, so currently its PE ratio is just a little bit lower than some of the other stocks within the industrial sector. And scrolling down, guys, taking a look at the price to book, which is another valuation metric we can look to, Lockheed Martin's is not great. 10.99, basically 11 for the price to book. And just so you guys have a point of reference, a price to book that we would like to see is like 1.0, okay? Between 1 and 2 is really considered to be like an ideal price to book. And the price to cash flow, which is the third valuation metric we're going to look at, is sitting at 14.13, and this is just barely over the sector median. And now after taking a look at all three of these metrics, we can see why Lockheed Martin is just barely skating by with its valuation grade. And a lot of this, guys, is just due to its recent run up in share price. Prior to this, the valuation was looking much more ideal. And honestly, I haven't run a discounted cash flow calculation or looked at Lockheed Martin's numbers for some time, probably since I started buying into this stock a handful of months ago. So I can't really speak to how fairly valued it is at the moment. What I can tell you about, though, is the dividends. Now, going over to the dividend scorecard, we can see that Lockheed Martin has a forward dividend yield of about 2.5, which is pretty average, very average dividend yield. They have a payout ratio that's really nice, actually, below 40%, which essentially means they're not paying out a ton of their free cash flow left over to the dividend, which hopefully means they should have the capacity to continue paying the dividend as the years go on, or hopefully even continue growing it. And based on the number of years of consecutive dividend growth, we can see that Lockheed Martin's really making an effort to increase the dividend as time goes on. They have a consecutive dividend growth history of 20 years and a 5-year growth rate that's actually looking pretty nice, just below 10%. And overall, I gotta say, I'm very happy with Lockheed Martin's dividend stats. Pretty average dividend yield, but I really like the dividend growth history, and I really like that 5-year dividend growth rate. All right, guys, now moving on to stock number 2, we have Chevron, which, as you know from the intro to this video, is another stock that I have in my portfolio. And in the last year, Chevron is just, I mean, look at that chart right there, guys. It's really climbing. In the last year, it's up almost 51%. In the last 6 months, it's up a whopping 60%. In the last 30 days, just in the last month, guys, it's up 16.5%. Look how steep that slope is right there. And then just this week, in the last 5 days, it's still up double digits, up 11.28%. Just like with Lockheed Martin, guys, it's very bittersweet to see what's going on with Chevron right now. Obviously, I'm psyched to see my stocks doing well and performing well, and I'm really happy to be up, what was it, 70%. 30%. But at the same time, it's like, I don't want to buy any more shares of Chevron right now if it's up 70% in my portfolio, because it means I'm buying it at a 70% premium. And hopefully in saying this, guys, it kind of makes sense as to why we dividend investors like to buy stocks at a discount. Obviously, it's nice to see them doing well. It's nice to see the share price going up. But really, at the end of the day, our primary goal is to create cash flow, which is why we buy these dividend-paying stocks like Chevron or Lockheed Martin. And because we're after that cash flow, we'd like to invest the least amount of money possible to get it, which is why it actually, for our purposes, is better to not have Chevron go up 70% or Lockheed Martin be up 30%. In fact, we probably would rather them be down. Anyway, I apologize for rambling on that subject, guys. Moving on to get into Chevron's valuation, it's not great. Seeking Alpha gives it an overall valuation grade of a D+, but having said that, the PE ratio is still really not too bad, 13.65. This is almost 25% higher than the sector median, but in its own right, the PE ratio is not too terrible. And scrolling down, guys, the price to book, forward price to book is 2.07, which actually is a lot better than what we saw with Lockheed Martin, but this is still higher than the sector median, 10.15% higher than the sector median price to book. And then looking at the last metric, the price to cash flow, I'm really not sure why Seeking Alpha gives it a D+, because it's 7.62. A single digit price to cash flow is something I like to see. And maybe the reason actually is because it is 35% higher than the sector median. So although none of these metrics are really too terrible in their own right, compared to other stocks within the same sector, they are a bit more expensive, which I guess comes with the territory of having a stock like this run up as much as it has. And moving on, guys, going over to the dividend page, we can see that Chevron has a forward dividend yield of 3.64%, which I do believe is considerably lower than where this usually sits. I actually think it's usually up in the high 4% or maybe even low 5% dividend yield range. But this is what happens when these stocks go up in share price. You're going to get less of a return from the dividend. Now, moving on to the payout ratio, 65.3%. In its own right, this is a little bit high, but I think energy stocks like Chevron or ExxonMobil usually come with a higher payout ratio. Correct me if I'm wrong, but I do recall seeing this being a common theme in a lot of energy stocks. Now, moving on to the 5-year growth rate, 4.82%. This is on the lower end, and this wouldn't be as big of a deal if the dividend yield was up where it usually is, which is, in the 4 to 5% range, but it's not. It's below that, and so with that, I would like to see probably a higher growth rate, but there's nothing we can do. We obviously can't control the share price. It's going to do its thing. And getting into this last metric here, the dividend growth history, Chevron has been growing their dividend for 6 consecutive years, but how long have they actually been paying their dividend for? So we're going to go over to dividend history, and we can see that they have actually been making dividend payments for 34 consecutive years. So this company really does have a solid history of paying dividends out to shareholders, much longer than I've been alive. So this is really good to see and does bring me some peace of mind as a shareholder of this company, because that's what it's all about, guys, getting those consistent dividend payments for years to come. All right, guys, now getting into the third stock of the day, we have South Jersey Industries, ticker symbol SJI, which is the only stock of the day that I do not have in my own portfolio. And for those of you who have never heard of South Jersey Industries, they're a company in the utility sector, and they operate out of, you guessed it, New Jersey. And in the last year, they're up over 30% with a gain of 31.72%. In the last 6 months, they're up very close to 40%, unreal. And then in the last month, just in the last 30 days, guys, they are up 37.65%. So this stock, much like the other two, has really appreciated in share price, man. And let's take a look at these 5 days. 5 days, this is actually still a pretty big jump in 5 days, 4.35%. And now that we've seen how much it's gone up, how has this affected the valuation? So like with Lockheed Martin, SJI is just barely skating by with this valuation grade. And the PE ratio is actually a little bit on the high end, 20.43, which is 4.27% higher than the sector median. It's actually not too bad, not too much over the sector median, but the price to book is really good. 1.79 for the forward price to book, which is actually over 5% lower than the sector median. So that's great to see. And this is something that we haven't seen with the other two stocks. And then they have a forward price to cash flow of 11.44, which is about 36% higher than the sector median. So that's not great, but overall the valuation grade of C- makes sense, guys. And then going over to the dividends, just so we can see what they're rocking with there, they have a forward yield of 3.59%, which is nice. Okay, a payout ratio that's also higher, 72%, but I do believe utilities tend to have higher payout ratios, and then a 5-year growth rate that's very low, 2.74%, with 16 years of consecutive dividend growth. Now, I do want to see how long they've just been paying their dividends. So, okay, 32 years of consecutive dividend payments with 16 years of consecutive growth. That's not too terrible. And as we zoom out on this dividend history chart right here, that looks pretty good. Pretty steep slope trending upward for that dividend growth. So I do like to see that. Now, after going through all three of these stocks and seeing how well they've all been performing recently, it makes you think about what to do. Are they too expensive to buy? Should you still pick up some shares? What's the right move? And truthfully, guys, I think all of these stocks are looking a little bit too expensive to buy right now. You could always dollar cost average your way into these positions, but I think there's cheaper opportunities out there. While they're good companies to own, I mean, obviously I plan to hold Lockheed Martin and Chevron and as long as I can. But for right now, I'm focusing my attention on some cheaper stocks in my portfolio, like Snap-on or Intel, which is still down quite a bit, or even Starbucks, which has been hovering around the $90 per share range now for the last couple of weeks. I think you could make your dollar stretch a lot farther by investing into those types of companies right now that are going down in share price versus investing in these that are going way up in share price. Not that they're bad companies or anything, but valuation is a very important component to investing in dividend stocks. That's just my take on the matter, guys. And if the tables turn and these stocks plummet in share price, I would highly consider adding more shares while they're down. But for now, I'm going to leave them all alone. And now with that behind us, guys, let's jump over to the screen and get into the weekly portfolio update. All right, guys, so here we are taking a look at my dividend stock portfolio here on Google Sheets. This is the dividend portfolio tracking spreadsheet I made, and I actually give this out for free. If you guys would like to grab this for yourself, there's a link to it in the description of this video. It's a very nifty tool. All you need to do is click the link. It'll open up a templated version of the spreadsheet that will look very blank. Definitely won't look like this when you first open it up. And what you need to do before you can start inputting your data is you need to go to File, you need to hit Make a Copy, and you need to click OK. And upon doing that, you'll be able to start inputting all of your stocks, all of your holdings, stuff like that. And to do so, once you make a copy of the template, just go over to the portfolio summary page and you'll see some yellow columns where you can start inputting data. And once you start inputting all the data, guys, it'll kind of start populating the dashboard and it'll start looking very pretty real quick. So if you want to grab it, the link is in the description. And now getting into the portfolio update, guys, as you can see, my portfolio is currently valued at $35,015.20, which I do believe is a new all-time high. Very exciting stuff, especially considering last week we were a little bit lower than this. As you can see, last time we did a portfolio update, this portfolio was sitting at about $700 less than where it is today at $34,388 with a total gain of 6.65%. But today, guys, we are up over 8% in this portfolio, which is very nice, very, very nice. And then the annual dividend income in this portfolio is sitting at $1,626.35, which if you divide that by 12 and average it out across every single month is about $130 to $135 somewhere in there. So that's how this portfolio performed this week. Now jumping over to M1 Finance, I want to show you guys the Roth. This is my Roth IRA on M1 Finance. It's much more simple than my other portfolio on Charles Schwab. And this one is just comprised of like 5 different dividend paying ETFs that I average into every single week. And all time, we are down nearly 10% in this portfolio. But in the last month, guys, we're also down actually about 5%. But in the last week, oh, okay. I thought we were going to be up this week. In the last week, we're also down 3.5%. So a lot of red in this portfolio, which is okay. Like we talked about earlier, it's good to see these stocks coming down in share price, especially when they pay dividends, because it means you're able to buy that same amount of cash flow for less money invested. It's just like going to In-N-Out Burger and seeing that they've got like a 50% off sale going on. It's the same double-double in fries. You're just spending half the money on it, which by the way would be a dream come true. Next time In-N-Out has a 50% off day, which has never happened as far as I know, I will be there stat. Anyway, that's what's been going on in the Roth IRA. Nothing crazy this week, guys. And getting into my purchases for the week, as you can see, it was a pretty eventful week for me for purchases. I put $70 into Snap-on and got about a third of a share of that company. I put $70 into Starbucks and got about 3/4 of a share of that. And then I said I wasn't going to do this, but I invested a little bit more money into AT&T, put $15 into AT&T. I got 0.63 shares, and I am now officially over 100 shares of AT&T. And I'll tell you what, Journeyman, if you're watching, this is for you. I told you I was going to do it, and I did it. So thank you for giving me the push to finally get over that 100 share mark. I needed it. Anyway, guys, my total contributions for the week totaled out to $204.99, which is a pretty normal amount for me to invest. I put $150 every single week into my Charles Schwab portfolio, and then right now I'm putting $50 every single week into the Roth. I'd like to bump up that Roth to increase those contributions, but I got to make a little more money before I can do that. And as far as next week goes, goes, guys, it's going to look more or less the same as this week as far as purchases go. I'm definitely going to buy some Snap-on. If Starbucks stays down, I'll pick up some more Starbucks. And then as far as a third stock, I might buy some Intel. I maybe will buy some 3M. I just kind of want to see what the discounts are looking like next week. But I'll definitely be buying those two, and then probably third will be Intel or 3M. Just not sure yet. And with that said, I will now get out of your hair. But if you enjoyed this discussion on dividend stocks today and seeing inside my portfolio, then let's keep the party going. Check out these two videos right here for more dividend stock content, and consider subscribing to the channel if you want to keep in touch and see more videos from me in the future. Anyway, thank you guys so much for watching. I hope you have a great day, and I will see you in the next one.